Hello everyone, and welcome to the Quantpedia Explains Trading Strategies video series. Today, we will speak about turn of the month effect.
Hello everyone, my name is Radvan Vojtko, I'm CEO of Quantpedia, the encyclopedia of algorithmic and quantitative trading strategies. The topic of today's video will be to show you what we do in Quantpedia and how we can use Quantpedia to find ideas for new trading strategies, and how we can use data from EOD Historical Data.com to backtest the strategies into improved strategies that you can find on our webpage. Let me give you some introduction to what Quantpedia does and how it does. Our main goal is to provide inspiration for new trading strategies and to give fresh ideas for new trading systems for anybody who is interested in algorithmic trading and quantitative trading. We do it this way: go through academic research. We are trying to find interesting papers, daily scan research portals, financial journals, university web pages, conference web pages. We investigate thousands of financial papers and we look for interesting ideas. Once we identify interesting trading strategy or interesting paper, we extract characteristics from the paper, trading rules in plain language, the performance and risk characteristics, distribute characteristics. So what are the instruments used for trading in the research paper, which markets are traded, what is the backtest period, etc., etc. And then we categorize each strategy by several keywords. The result of all of this work is our database. Our database consists nearly 800 strategies. You can easily screen through all of the database and look for ideas for new trading strategies. The trading strategy that I selected for today is called turn of the month. The turn of the month is a very interesting effect. It's known for a long time. The turn of the month says that there is a significantly higher probability that US equities will perform well around the end of the month and the beginning of the new month. Now, the actual period during which we should hold the US equities or US equity index differs from paper to paper, but usually it's the last 4 days of the month and the first 3 days of the month. Backtested performance of such strategy is interesting and it performs significantly well in the last years. And we will try to backtest this strategy by using EOD Historical Data.com. I will show you how. What is the EOD Historical Data.com? It's a provider of historical data and financial data APIs. It provides over 40 years of data. I have multiple exchanges all over the world, 150,000 tickers, 20,000 ETFs, 600 indexes, etc., over 1,000 forex pairs. They provide a lot of the data. What they provide is multiple different APIs that we can use to connect to their dataset. What I will show you at the moment is how to use the Google Sheet add-in or plugin and how to backtest ideas in Google Sheets. You can use also Excel add-ins and some APIs. You can read the whole documentation at their webpage. How you can access the EOD Historical Data. The easy way is to integrate the Google Sheet financial add-in into our Google Sheets, and we can easily find any data that we need. So, for example, by US, I can select starting date, ending date, etc., and I will receive underlying data directly into Google Sheet. That's what I did, and I asked for prices for SPY ETF, and I received the prices for SPY ETF, and then we use the adjusted close dataset or adjusted closes, so the closes with splits and dividends adjusted prices to backtest the turn of the month strategy. How does the backtest look like? So firstly, we need to copy end of day data for SPY ETF, and then we can calculate the daily performance. It's easily done by dividing the today's price by previous day price -1, and we can check what is the performance of the SPY ETF from the beginning. We can see that the performance is 9.67% with the maximum drawdown 55%. We earned nearly 10% a year over the last 40 years from 1993, but we had multiple significant drawdowns with the highest drawdown over 50%. We have a ratio, so we can compare what is the ratio of performance, our yearly performance, compared to maximal risk. So in our case, it's the maximum drawdown. We can see that our benchmark, so when we just hold US equities, we have the performance to drawdown ratio 0.18, which is not bad, but it's also not the best. As I said, we have like 10% performance, but with nearly 55% drawdown. Now, how we can improve this performance? So we can try to build this turn of the month strategy. Firstly, we need to identify when is the first day of the month. We can do it easily by checking and comparing whether the actual date is in a new month or still in the old month. We will have the number 1 in case there is a difference between the actual month and the previous month. This way, in this equation, we can easily find what is the first day of the month. Now, once we have a first day of the month, we can check what is the D-4 day, D-3, D-2, D-1 day, and then first 3 day of the month. So these 4 are the last 4 days of the month, and then first 3 days of the month. Once we identify all of those days, we will identify the period that starts 4 days before the end of the month and holds until the 3rd day of the new month. And we will hold equities just during these 7 days. And we can check what is the performance. So what is the performance during the turn of the month season or during these 7 days. We can see that we have nearly 8% performance with a significantly lower drawdown. So our performance to drawdown ratio improved from 0.18 to 0.46. So we do not need to hold equities all of the month. We can hold equities only during the turn of the month period, and we can have nearly the same performance as holding stocks all of the month with a significantly lower drawdown and with a significantly improved performance to drawdown ratio. Here we can have a chart, and this chart is showing what is the performance of SPY benchmark and what is the performance of this very simple turn of the month trading strategy. Can we improve this trading strategy? Of course, there are some ways how we can improve it, and I will show you what we can do. The first important thing is to try to check what is the performance of during each day. So what is the performance in a day D-4, D-3, etc., etc. So we are trying to identify what are the days that are driving the performance of the turn of the month anomaly. So what are the most significant days when the equities are really outperforming or when the equities are really performing? So when we do this analysis, you can see that not all of the days are the same. The day with the significantly highest performance is the first day of the month. Most of the other days also provide their performance into the overall trading strategy, so into the overall turn of the month anomaly, but first day of the month is the strongest. Sometimes the turn of the month anomaly is traded only during the first day of the month, but when we trade a strategy only during the first day of the month, we do not have such strong performance as we would like. So we have only 3% performance. Of course, our drawdown is significantly lower. Our performance to drawdown ratio is still interesting, not such high as during all of the 7 days, but it's still significantly more attractive than just the benchmark performance, but we would like to increase the performance of this first day. How we can do it? By applying the leverage. Before we apply the leverage, we need to nothing more. What we can do is we can try to apply the trend or momentum filter to even increase the probability that we will pick correct with the highest probability of positive performance. How we can do it? Let's check how we can apply the momentum filter. Here we have again the performance of the benchmark. So it means buying and holding SPY ETF, holding the S&P 500 index ETF. Once again, nearly 10% performance with a 55% drawdown. We will calculate the 20-day momentum. It's a signal that says whether the current day price is higher than the price 20 days before, and we will use this as a filter that will tell us how to improve the performance of the underlying turn of the month signal. Our next rule is a little more complicated. What we will do is that we will combine the performance of turn of the month signal with the previous day momentum. So what does it mean? We will check whether during the turn of the month period, previous day 20-day momentum was a positive. Only in this case we hold the SPY ETF. In case the previous day momentum is a negative, we do not have any position. As we can see in this example, turn of the month signal says to us that we should hold the SPY ETF, but the momentum is negative, so it means we have no position. I can move a little higher. Let's move here. So if I move here and I check the equation, I can see that the SPY, the turn of the month strategy is telling us to hold the underlying SPY ETF. We have the positive 20-day momentum, so it means we can hold the underlying ETF in this case because the momentum is positive, and also a turn of the month period says to us that we should hold the US equity ETF. What is the performance in case we use this momentum filter on whole 7-day period? So we can see that we were not able to improve significantly performance of the underlying turn of the month strategy. But what is the most interesting is that when we apply this filter only to first day in the month, So when we apply this filter only one day in a month, here is the case, we do not apply this momentum filter to the strategy that holds SPY ETF through all of the 7 days, but only during the first day of the month, we were able to significantly improve the performance to drawdown ratio. If you remember correctly from the previous sheet, we had the performance around 3% and maximum drawdown around 11%, and the performance to drawdown ratio was around 0.26. In this case, we have a little lower performance, but our drawdown during the first day is less than half, so our performance to drawdown ratio is significantly higher. So now we know that when we combine the term demand period, when we hold the SPY ETF only during the first day of the month with the 20-day momentum filter, we can significantly improve the overall performance to drawdown ratio. Now it's time to apply the leverage. When we want to apply the leverage, there are multiple ways how we can do it. The easiest one is to use the Ultra S&P 500 ETF. SSO ETF seeks daily investment returns before fees and expenses that corresponds to 2 times the daily performance S&P 500. So that's the easiest way how to do it. We can, instead of buying SPY ETF for the first day of the month, we will just buy SSO ETF, which will give us 200% allocation to S&P 500. It doesn't make sense to hold this ETF for a longer period because during the longer period there is a significant volatility drag for these ultra, double and triple ETFs, but when we hold this ETF only for 1 day, it's a very easy way how to obtain the leverage for our trading. Let's move back. We can use EOD Historical Data plugin. We can place here SSO.US ticker. We can select the period from which we want to get the prices, and we can get the prices. We can see that the SSO ETF started in 2006. So we have like 16 or 17 years long backtest, so that's long enough. Let's move on and let's try to apply the leverage. So here we are, and we are trying to apply the leverage in this sheet. In this case, we copy paste the adjusted close prices for SSO ETF into next sheet. We calculate the daily performance, and then once again we try to identify what is the first day of the month. So we have a equation or formula that's giving us number 1 when the current month is different from the previous month. So it means that, okay, we know that we need to hold the underlying ETF because it's the first day of the month. We will check the signals for period D-4 until D+3. So last 4 days of the month and first 3 days of the month. We will try to apply the term demand strategy on SSO ETF. Firstly, we will try to apply just the naive or simple strategy that holds underlying ETF during 7 days around the term demand. And we can compare it against the performance of SPY benchmark. So when we apply the leverage, we can see that we have firstly significantly higher performance. So instead of 9% performance, we have nearly 15%. We have significantly lower drawdown. So instead of 55%, we have just 31%, which translates into significantly better performance to drawdown ratio. So instead of 0.17, we have 0.46. The number for SPY a little different compared to previous numbers from the previous sheets because we are doing backtest from 2006 because we have data for SSO ETF from 2006, not from 1993. But we still have 16 or 17 years period of the backtest, which is nice enough. So we can very, very easily improve the performance of SPY benchmark by using the leverage and thus holding the underlying S&P 500 stocks only during the few days of the month. Now let's move on. We will try in this case to apply the turn of demand strategy, but also with the momentum filter, but just for the first day of the month. So instead of using 7 days, we will just use the first 1 day, but we will also apply the momentum filter. What are the final rules? We will hold the SSO ETF during the first day of the month in case at the end of the month the previous 20-day performance of the SPY ETF was positive or underlying S&P 500 index. So we are checking if the index has a positive momentum, short and 20-day momentum, and if in case there is a positive 20-day momentum, so we are in an uptrend. At the end of the month, we buy the SSO ETF, which gives us 200% leverage for the underlying S&P 500 index, and we hold it for 1 day. What is our performance? So we have nearly 5% performance with a negligible 9% drawdown. Performance to drawdown ratio is 0.52. So we have significantly better performance to ratio or performance to drawdown ratio than our benchmark case. Our performance is half of the benchmark performance, but our drawdown is 1/6 or 1/7 or 1/5 of the original drawdown of S&P 500. So our equity curve looks significantly better. So thank you very much for your attention. Now, this was the first video that I built for a Financial Academy webpage on EODHistoricaldata.com webpage. I will show you multiple other anomalies that are present in financial markets. I will show you how we can improve these anomalies, how we can mix these anomalies into multi-strategy portfolio, and I will try to show you how to use EOD historical data for this purpose. So once again, thank you for your attention, and I hope you will join me in the next video.